Well, I'm going to the city and I'm gonna do a silly show. And I know all my fans wanna learn how to make some dough. We're cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week. And then a look forward at what might happen in the next week. And hopefully, lots of great ideas and opportunities for you throughout this show. Well, the stock market moved lower last week as investors focused on worsening prospects of a V-shaped economic recovery. Fed Chair Powell didn't help things at all in his Wednesday morning speech, in which he painted a very ugly picture of a long road ahead. It's one of the few times that I really heard him be very realistic, where he talked about scars left by the long-term recession. He did say they'll use all tools that they can in order to help the very weak economic conditions that he painted. But then he did say that they would not use negative interest rates, which I have to, again, give him some kudos for, because negative interest rates are simply a killer. So we heard that from him, and those words that he used, well, he stopped short of the word I would use, because I would say we're in a depression. But with the programs the number of programs that the government is using, splashing money all over the place, and all this horrible data that we're seeing, and the long-lasting effects that I think that we're going to have as far as the damage done to this market, I think the history books will call this the Depression of 2020, maybe also 2021. Examples of the horrible data that is coming out, well, the CPI lost 0.8%, the core -0.4%. That's the weakest overall reading in 63 years. Industrial production crashed 11.2%, capacity utilization at a record low. Initial claims for unemployment up another 3 million, takes it to 36 million total. It's easy a 20% unemployment rate that we're going to see in the next report. And add to that the IATA report, which talks about the transportation industry. Well, they said airline traffic was crushed, not expected to return to 2019 levels until 2023. That is an extremely damaged industry, and you talk about scars, well, that's what he's talking about. The stock market did have dramatic moves since the February peak, 35% on the downside, and then followed by a massive rebound. In fact, the NASDAQ gained 37% off of its lows. Now, I'd like you to go watch our Thursday video for members, big picture analysis on the U.S. stock market. And I also show a very, very unique style of analysis where I look at the momentum in different sectors, and show you a different way to look at momentum and do comparisons in that. When I did that, I showed how the upside move has been led by tech stocks and healthcare, and looking at those sectors. Healthcare actually stalled 3 weeks ago. They were moving up because of the fact that investors think that techs and healthcare, they're the COVID beneficiaries as we shut down here for the last couple of months already. But there's also signs that the tech group is starting to stall also. If you saw the news that came out today on Friday, that Foxconn, which is a huge Apple supplier, had pretty poor earnings. And Apple's down on the day-to-day, and it's actually been lagging in here. And the market in Apple has been incredible, as buyers have just come in consistently, and analysts raising those targets pretty consistently. They think that it is impervious to this horrible economy that we have. Well, I don't think that's true, and Foxconn may be giving us a little bit of a heads up onto what Apple's going to be suffering moving forward. Anyway, the tech stocks are looking to me like they are stalling here. So that leadership of healthcare, which has already stopped, and tech stocks, which are stopping, looking like they're stopping right now, that looks to me like we've kind of declared an area in the stock market where there is pretty good resistance. Now, I'm not indicating, and I don't really believe that the rebound that we're in is over, but this does suggest a rotation. And we are noting that there has been some reversals, especially on Thursday of this week, on May 14th, in the financial category. So a lot of those bank stocks look like they've made lows. We're not looking for big earnings or big improvements out of the financials. In fact, with interest rates down at zero, their prospects for making money are pretty feeble. And with M&A really horrible and trading conditions pretty horrible for them, overall the earnings for the banks, they're not looking good. But investors like to try to pick bottoms, and we're noticing bottoms forming in there. So we do think that those will be the stocks that potentially could do better. Our work does show a little more time for the rebound that we've had in the market, but maybe not much price-wise. As we got the S&Ps up to 2950, maybe they can nudge that number out here in the next couple weeks. We're looking for banks to take the lead, actually, and that will make investors happy because they like to see that group tick up. And we think that after that, the prospects are pretty horrible. Even with negative interest rates off the table, which would be really bad for the banks, we think that the stock market's upside move led by banks would not get all that far. And we do think that while there may be the leaders or new leaders coming up in these next couple weeks, come June, we think that the risks are much higher and that the stock market will be moving down in some sharp way again. We actually have targeted, and you've heard us say this, towards the end of the summer, we think we're going to get a pretty nice sell-off. Now, we've upgraded our downside projections, but we still think that there's a lot of risk into that July, early August period, and that the best we can see is this rebound extending up into sometime maybe early to mid-June. The stocks for the week, the S&P and the NASDAQ, they were down 2.5%. As the NASDAQ a little bit weaker. The Russell, though, really took it down well over 5% as tons of sellers came into those low-price stocks. The bond market moves up about a half a point. 10-year yields are down about 4 basis points to 64 basis points. We're going to see them probably waffle in this area between 40 and 80 basis points for quite a while before they eventually take out that 40 basis point low. Gold surged $50. Percentage-wise, that doesn't even compare to the silver market, which absolutely exploded. A 7.3% gain on the week right now, up about $1.15 on the week. Massive move. If you watched Future Speak, which is our Wednesday show for Level 2 members and up, we talked about the potential for this upside surge in the gold and silver market, and just beautiful this came, and getting emails from people both who caught the move and from people that missed the move and want to know, well, what now? How do I get in? Well, we'll talk a little bit about that at the end of the show. Dollar up about 0.4%. We still think it is stuck in a pretty good range, and oil moves up close to $4, like 16% on the week, and moving up into a resistance area that we talked about, and we'll talk about that also on the short-term view. So that is the opening of our show here, and I want you to remember that you can follow us on YouTube, so follow and subscribe on YouTube, and make sure you share information. Give us a thumbs up on if you're watching this on YouTube. If not, go there and give us a thumbs up. You can put comments on there also. Subscribe to this channel, share it, and click that bell so that it sends you the notifications so that you know when we put up videos. We put up a lot every week, and I think that our membership, our following has just been exploding, and people are just loving the stuff we're putting there. So please do subscribe to our YouTube channel. Follow us on Twitter at askSlim, and you can write to matt.com. Our trial membership period is ending in about 2 days. So if anybody has any of those old trial links, you can still use them, but we're ending them this weekend, so we will no longer have those trials available. So please do take this last chance to do that. After Sunday, you will not be able to get any trials. This whole trial period is ending. That is it for the opening, and we're going to go now to what we love to bring you here, the best and the worst stocks for the week. What we do is we look at our weekly patterns here. We are cycle analysts, and cycle analysis is looking at money flow. It's a visual depiction of it, and it's an art form that we bring to you as we start with a blank canvas and do all of our drawings and analysis and projections, put in our support and resistance zones, and bring some of the evidence to you so that you can apply it to your trading. You can also learn about cycle analysis by going to our website under workshops and look for that cycle analysis workshop, and there's some great information for you there. So now let's get into the best and the worst stocks for the week, and I'm going to move over from that one to Bristol Myers is where we're going to start this, BMY, which is on the list for the best for the week. Look at this cyclicality in here. So you can see in the bottom the cycle brackets. Those are guides for us so that we can see the rhythms in the market. And you can see this big gain off of that last low that Bristol Myers has. It's up about 7% for the week on that nice gain. What we're looking at here are the cycle brackets. So the low due right over here, an amazing low that was completely invisible right in here, and then the low due right over here. So you get this big gain right there. And when you get an invisible low like you have right over here, or just that tiny little dip in line, what you have is what we call a swamp cycle. The upside momentum is so strong that they can't even give you a dip in there. So Bristol Myers, we are in this stage right over here, rising, as you can see. And the news in here is they had very good results on a couple of drugs. Cancer drug combo that they're using has extended the life for lung cancer patients, and they've been approved on for an AIDS drug. So the stock has really been moving up based on that, and makes sense. The target up over here you could see is about $68. And this is a big move on good news and a great looking pattern when you see that. The next one we're going to look at is one that we don't show you very often, and it's Okta. Okta is in the software category. I'm going to show you the bigger cycle patterns first. What's really interesting in here when you see, I just want you to note the price of the stock. So the price of the stock right over here, you could see, made it up to this week, $182.61. Now look over here at what the projected earnings are in 2021 and 2022. Something is not making sense to me. This moves up with the techs and being in the software category. Got dragged up, and like I said, there are signs that the techs are topping. Look at the cyclicality in here right now, and if you look at what happens when you get into the corrective period in the second half, you get some pretty big declines. You see that right there. This one actually was a modest decline. This was a steep decline, a very large percentage, as was this one here. And now we get way up here. This is some kind of, I'm going to use a very used up word, irrational exuberance, as they're buying this stock. Makes no sense to me. I would not be surprised to see the stock come back down and at least test this breakout level right over here at 142. That would be 40 points on the downside in this corrective period right over here. No news, outrageously priced. I don't know what they're smoking, but this is really a crazy valuation And I have a sell on this. I mean, it makes no sense to me at all, and I think the stock is going to move sharply lower. Three more things we're going to look at here in the best of the week, and they're all about silver and gold. So I'm going to show you the silver futures in here, which had this massive move. And you can see in here the cyclic patterns. Now, this is a very busy chart. For those of you that are not familiar with future speak, where I bring this chart normally on a weekly basis, these show the cycles in gold, they show the cycles in silver, and they show a very dominant pattern that showed up right over here in silver, which is now rising strongly into this upper resistance sell zone. So there's a likelihood that it stops right over here at about 1730. But if it gets through there, that's an important 78.6% resistance. It's off to the races. And we talked about last week, if it gets above this area right over here, man, it could be really explosive. So we think that it's a really bullish pattern. We talked about this consolidation right over here and the likelihood of it moving up. And that is a very, very good move that we see on the upside. It's just simply that it was very, very undervalued in relation to gold. And if you have any belief that the economy is going to recover at any time, and if that's why any stocks are going up, because they're looking beyond this horrible economic condition, then silver should also be going up, as should the other metals. So this is a very, very strong pattern that I show you in here. And let's just look at two stocks in this category. First one we'll look at is Pan America Silver, PAAS. This is one we regularly look at. This has our colored phasing in there. And again, we have all the important cycles in there. When it's green, it's a rising phase. When it's yellow, it's a consolidation phase. And if it turns red, there's a lot of risk, downside risk, and as you see right over here. So let's just look at these last couple cycles right in here, and you can see this. I can't even keep up with it. I mean, it is storming on the upside over here. We're getting into a corrective period potentially in here for some kind of a dip. We could see this pulling back to 22 bucks, and I'm telling you, I think it would be a screaming buy. Here's some supports from the daily pattern right in here. Big support way down over here. I don't think it could get near it. And I think it's going to be heading up towards this area of this high at around $26 sometime in the summer. So we would look for a dip in here to buy, and I think it's a great, great looking stock, up about 5.5% for the week. And we'll take a look at Newmont, which is also up about 5% for the week. On a very, very strong upside move. I think it's closer to 6% right now. And you can see a similar pattern in here, as it looks like it's going to pull back and then get a rally. But the real upside target is right up over there at around $77. So given this dip right in here, I think it is a strong buy. We've been bullish on silver and gold. Gold stocks, when you look at the video that I did on Thursday where I show sectors, I talk about the momentum in gold and GDX also. You don't want to miss that, and I make a very good case for the fact that the reason that the gold silver stocks were way ahead of this move, moving up strongly before gold and silver had this pop this week, is because they have a lot of catch up to do on the upside. So you're going to want to look at that. When you look at that video, you'll really get a sense for some still significant, very upside potential in these gold and silver stocks. So that is the best for the week. On a down week, as you could see, it was only a few things that really are not very market related. And that OKTA, I just don't get that valuation. I wonder what they discovered that we don't know about. Well, if they didn't, the stock is going to get hammered. Next, we're going to look at the worst of the week, and we're going to switch over into the airlines. Earlier in the show, I talked about airlines and talked about the IATA report, which says that they are not going to recover for 3 to 4 years. That makes sense. Here is SAVE, 19% down on the week on an analyst downgrade. You can see this low at $7, and this week it got down here to about this was 701. This one right over here is 720. So this is a weekly pattern, and this points all the way out till August before this can turn up again. So this one is just in sick shape. You gotta wonder how some of these are not going to go bankrupt. Well, maybe the government will just throw some more money their way and keep them from going bankrupt. But UAL down about 15% in the week. Let's take a peek at Delta, DAL. See that right here? And you can see that Delta is in a red zone. So that red zone goes out to July. The prospects of any rally holding in here are very, very small, as this is what we call a left-hand translation. So what a left-hand translation is that a stock that makes its peak very early in the cycle right over here and then comes down and takes out or challenges that low. It sets up a long period of decline, and it could go pretty deep. So the stock now is trading at 19. Why can't it be a $10 stock? Why can't it get cut in half again? It certainly can with the very, very poor prospects out there. Delta comes out, and this is the worst pattern of the ones I'm going to show you. And they talk about being overstaffed this fall by 7,000 pilots. Just an amazing thing. And that just speaks to the type of devastation in this group and to what is likely to be out there as far as unemployment conditions go, as these are going to have to be, sadly, pilots that are let go or are furloughed. So really tough situation for the airline stocks. It's also the case for apparel. So we're going to look right now at two apparel stocks and take a look at TPR, Tapestry. Tapestry, this group just hammered. And this is, let's just talk a little bit about cycle analysis right now, because I want you to understand more and more how we do this and how important it is for you to take our workshop. These are cyclical harmonic families, and they're very clear. What you have is the dominant one, which is at 32 weeks, and the minor one, which is at 16 weeks. And you can see how each of these cycles is divided in half in these patterns. And where we are right now is the first rising part over here already failing, as it could not even get up to the sell zone right over there. You can see in here bullish support zones, all of that holding the market up, and it keeps going up. But if you look just in here in the downtrend, you can see those resistance zones, and what happens, you get close and it gets creamed into the last sections of these declining phases in the cycles. And here it couldn't even get up there. Maybe if it can hold above 10, it will have another shot somewhere out over here. But if it breaks 10, it's going to be in a terrible, terrible shape. As it is, it's in terrible shape. The best I can see for this is some recovery back up over to 18. Believe me, that's a 50% gain, and I'm not calling for it. I just think that that is, right now we have this in what we call the ideal or normal shape, but this really needs to be downgraded in here. If this gets any lower, it certainly will be, and Tapestry is terrible, and I would say uninvestable. When I look at that, we get a 12% drop in apparel prices. That is amazing. They are, Tapestry, trying to open a few stores in the U.S. and Asia and Europe. Who's going? I don't know who's going to go. I don't know how they're going to keep people safe, honestly. And you got to still deal with clerks, right? I mean, it's a tough situation. Next one we're going to look at is Capri, CPRI. And you're going to see in here a pretty similar situation. Here are the cyclical patterns. The bottom that made, you can see the very, very nice patterns in here. There are some minor thirds visible. And you can see it gets into that lower sell zone and just stalls for the last month there. Maybe it could make it up here to the bottom of this area, about 18.5. Again, that would be a very, very large percentage move. It could happen, but overall, this is a very sick pattern, down 9% on the week as analysts downgrade this stock. I want to note that Nike was down 3.5% on the week as analysts upgraded that stock. I have downgraded Nike, and I think it's going down to $75. One more stock that we're going to look at in here is Cake because, well, the restaurants are also in sick, sad condition. How they're going to make any money when they can only have 25 or 30% of the capacity seated, when people are going to be coming in and wearing masks and gloves and concerned about the servers and concerned about the cooks, and all of that is just a horrible situation for the restaurant industry. So yeah, I've been painting a bleak picture here, and it is bleak. It's not going to get better for a long period of time. This stock peaked, of course, way back a year and a half ago, up at around $60. It falls to $14.52, and the odds are pretty good that when you get into this, remember I talked about July, August as the time frame? Well, here's the target zone, and it already hit that. So what that means is that the next target is down here at 14.52, and I think in the summer we're going to see all-time lows in Cheesecake Factory, a very, very bad pattern, down 14% on the week, and several analysts have downgraded this stock. That is a look at the best and the worst stocks for the week, and some pretty sick situations there when you look at the worst for the week. Three very, very tough groups. In the airlines, the apparel group, and in the restaurants. All right, so now we're going to get over into the short-term view for the coming week, but before I do that, I want to talk about our SIR report and live stream and our level 2 membership. This is a picture of just the amazing stock index report live stream. This is a chart that we put out every single morning. It's part of our daily SIR report. And then we have a live stream that is sent. We send a link to our level 2, 3, and 4 members where they have some of the best information that you have ever seen. And the amount of users in this is just growing substantially. What we give you on here is the S&P 500, NASDAQ, and the Russell in 3 different charts. These are 15-minute charts. What we want to give you is the best possible information for the purpose of your directional decisions and for the support resistance levels where you may get turns and for acceleration zones. The yellow areas are acceleration zones, and when they get into them, a very high percentage of the time they move through them. You can see that right over here as it gets right down to the support in the NASDAQ right over here. It plunges through it right over here and gets right to the support on the Russell. And when you get the support on all 3 of them hit like that, and then the reversal scout turns up, there's a pretty good chance you're going to get a pretty big rebound. And we got a very big rebound. This is from Thursday the 14th. That's yesterday. So I wanted to bring you this pretty complete picture. This is a phenomenal thing. Again, this is live right on your computer. You don't need any special platform. We're just going to send you a link and you just click on it and you have it. We're going to do that every single morning. On top of that, you are going to get, by becoming a level 2 member, you're going to get all of this. Level 2 membership, which is the stock index report SIR daily, the stock index report live stream. So the SIR daily's got lots and lots of information on there about the indexes. Stock index report live stream and daily. You're going to get our weekly stock index report, our weekly ETF report. Those are all level 1 products. And our Slimulator Momentum Tracker, one of the most amazing things you'll ever see for longer term for investors or position traders, with a ton of information on there, more than 1,000 symbols you can check for momentum conditions, and you get our proprietary output in there, which is our really what we're looking at to happen in the next 3 months. So amazing information. And on top of that, you get all 500 plus of my videos that I have recorded, 80 of them on how to use different tools for text, trader psychology, stock index, stock groups, sectors that I do reports on all of the time, big picture analysis. There is so much in there. You're never going to find anywhere else to learn as much. All that is $45 a month. And again, like I said, if you have any old special links from us, they're going to all be done on Sunday. So that'll be the last time that you'll be able to use them. But you can still have all of this for just $45 a month and a special discount for 3 months subscribers of 15%. So you want more info on that, on all of that, write to Matt at askSlim.com, and you're going to get all of this absolutely amazing information. Look at all that is here. All of that for $45 a month. Give me a break. I mean, how can you not subscribe to this if you are interested in the markets? Just a fantastic information. And if you want to learn about our level 3 and level 4 memberships, you can write also to Matt at askSlim.com or go to the askSlim.com website. That is the information on level 2 and this amazing, amazing daily stock index report and live stream. All right, so now let's get into what you've been waiting for, which is the short-term view for the coming week in the 5 major markets. Always want to be accountable to what I said. Now remember, I'm talking about the next 1 to 3 weeks when I do this analysis. Basically the only one I really missed badly was the bond market, and it's not even badly. It didn't really go anywhere. We had expected it to move to the downside, and it just basically moved sideways or barely to the upside. So that was one we don't get any credit for, and we talk about that in future speak as to the changing conditions in the bond market. So you're going to want to watch that. Light crude, we expected it to move up to resistance and then turn lower. Well, it hasn't turned lower yet. In fact, it's on its recovery high, so we only get partial credit for that. The gold market, we actually dinged ourselves because it didn't sell off quite as much as we thought it would, but we get most of the credit for that one because we were looking for the upside move. And the stock market, we're going to call that pretty much a bullseye, as it came down and absolutely tagged the level that we thought that it would, and then got a bit of a rebound, but it's not really rebounding a whole lot in here, as the market is still down somewhat here today, as just a modest recovery off of its lows. And maybe still some issues yet to come, and we're of course going to talk about that. So I'm going to move over into the daily charts. I'm going to start with light crude /CL. And here you're going to see that it has the cycles in there, and what we were looking for was the potential for it to get up to 30.30, and you could see it's still been moving up in here. Now the momentum is improving, but it's not locked in as positive yet. And you can see how tight the slim ribbon is in here. When it's really negative or really has intensity, you can see right over there how it's wide. But when it really narrows like this, you have to be suspicious that when you get the upward turn in momentum, it's not convincing. It's improved definitely, and what that has given us is an upgrade in here. Where we were looking for a move down to $15, now we're really looking for the move down in here over the next 2 weeks to closer to $20. Now that would be losing about 45% of its value. So that's a pretty bold call that we're making in here. But we still think that traders will be nervous about the coming roll and whether or not there's any storage or any place to put light crude. So that was the reason why it collapsed to minus $40 here, and it came up to resistance, which is not a surprise, but we are looking for it to roll over and turn to the downside there in the light crude market. So some of the evidence just basically says to us that it's up into intermediate resistance area. The risks are for decline into late May, even though momentum has improved ever so slightly in there. So the next thing we're going to look at is this surging gold market, and we have this analysis in here that looks really good. You'll note that we have the silver right over here. That's the dash line, and the gold, which is made up of these minor thirds. Silver is made up of the minor thirds also, and they're slightly out of phase. Now, the phases are actually getting closer because they're both moving up pretty strongly. This gray area that we're looking at right over here is what we call the nested area, as that's where the gold and silver lows were supposed to come, and then supposed to get the move upside right in here. I don't even like the word supposed to. This is where the rising phase begins, and that's what gives you the biggest upside moves. You see that right in here. Well, it took the second cycle to make the big upside move. This one, the first and second and third cycles all had good upward pops, and now you got this one going right over here. So what we're looking at is continued upward movement in here. Our target for the gold market is about 1790, right up at that cycle peak resistance. This was the silver outperform area that we thought would happen. I want you to note that the gold market is up 1% today. The silver market is up 5.6% today. So we did read those very well. And if you were trading the pairs trade, where you long silver at the proper ratio with gold, based on that analysis, well, you're hitting a home run here because it's really making a difference. The target then is up at that area. The next one would be up here at around 1830 or so. So that's our target, 1790, 1830. There was a big pennant formation that you can see in here. It shows up very clearly on the weekly chart. So the weekly chart is giving us the sum of the evidence, which shows momentum improved in here, but again, not convincing yet in the gold market, just like we said in the light crude market, and that the upside potential is to those resistances, 1790, 1830, and we believe a potential for record highs. So very, very strong intermediate conditions, and the sum of the evidence has been that it's going to move up, and you can see that is the case. Next thing we'll look is $ DXY for the dollar. And we expected it to be stuck in a range, and it's basically stuck in a range. We thought 1040 was going to be the upside of the range. It got up to 1058 or something like that here. We thought the downside of the range would be around 98.90, and that has not, it didn't get down to there. It closed there Friday, right over here you could see, right near that, but then it gapped up on Monday. So the pattern is in this slightly rising pattern. Again, there's so many things that have been moving sideways that you don't quite get the convincing upward turn in momentum. You have that here, it turned up, but it's not convincing yet. The momentum has been extremely choppy as it's been in this sideways movement. And you have a slight VTL breakout there. That's that downward line right there. Learn about VTLs in the cycle workshop. So what we see in here is for the next couple weeks really is an attempted move to the downside, not getting very far, an attempted move to the upside, not getting very far, and then down again. And the risk's kind of picking up for more downside in here. Some of the evidence basically says it's stuck in a narrow range. We're expecting this chop. We have slightly upgraded to 1080 on the upside, to about 99 on the downside, right around over here as the range, but that's not much different than we were. We just don't see it breaking out of this sideways movement for a while yet. You have the Fed, which is keeping interest rates very low. That's not necessarily good for the dollar, but interest rates are low everywhere. So it's really about the debasement of all fiat currencies as they trash. Every single central bank is trashing money right now. And there's only one thing that means, and that means that real assets gain in value. Paper assets lose value, real assets gain value. And that's why you see silver and gold doing what they're doing now, just very much in line with what we were talking about. Now we're going to look at the /ZB. This one has been a major disappointment to me. Look at the momentum in here. It's just at zero. I mean, it gives you an up arrow, but it's not convincing either. We were looking for this declining phase to give you a big break. The Fed will not allow this to pull back. They don't want interest rates to go up. They're in there buying everything, and that's why this didn't pay any money for me, who's been on the short side in here. Well, not anymore, because we're running out of time. You've got 1 or 2 more weeks in here for potential decline. We're still going to look for some potential decline in here, but the targets right over here of 175 on the downside does not seem realistic anymore. It may just test this lower level right over here at about 177.5, 178 over these next 1 to 2 weeks, and then begin to move to the upside again. This really only shows here about 5 days. Maybe it could run a little longer if they start to sell it, but there's just not any time left anymore. This triangular consolidation is very bullish, and that's why I said in the beginning of the show that at some point we're going to take out that 40 basis point yield in the 10-year because of the way this pattern is set up. So bond market disappointed me as a short seller, and I don't think that there is a lot more downside potential in here. All right, so that is a look at the first 4 markets, like crude, gold, the dollar, and ZB. So now we're going to look at the stock market. We had looked for the stock market to pull back, and our targets were 27.75 in the S&P 500, 26.70. I'll show those to you. And as we said in the beginning of the show, we don't think that this downside is going to last, and there's more on the upside in this upward correction in what I believe is a significant bear market. So let's take a look here as we switch over to SPX. And we're going to look in here at the cyclical patterns. Again, now we're focused on the what is a dominant pattern right over here at about, it runs 18 to 20 days. You can see in here this bottom, it was 20 days off of the previous low. And this one was very short at 16. Part of that was because the intermediate pattern bottomed early. And I showed that also in Thursday's video on the big picture of the stock market. So you got this 19-day pattern right in here. Now you also have this middle, the smaller minor cycle pattern. This was the low of that pattern right over here, and that was at 8 days. So where we are right now is this was an 8-day low. So that's like 16, right? We're in day 17 here. The question is, are we going to be in 16-day cycles now? Well, it's not likely. It's more likely it's going to fall one more time and take out this low. Our projection was to test this area around 2770, 2775, and it got right down to it and bounced. I want you to note that momentum is still positive in here, though it is weakening. As you see that, it may not be enough to lose this upside momentum. It's not as key if we lose that. Then what would be key if we broke 27.27. You could see that right there. And the note that we have, if it breaks that, it would be an indication of the intermediate top. That would mean that the next rally, which you can see projected here, would be far less likely to take out this level here at that last high that it made, which was at around 29.55. So if it holds above this level here at 27.27, which it's looking like it will, right? Then the likelihood is it will take those levels out, and maybe even get to 3,000 in here before it then succumbs to what we think is a lot of weakness out starting in June into the early period of August. So this is very key. If they really start to sell them again and you take out 27 in the next few days, well, then you know that there's more trouble. If they hold in these areas and then start to move up here, well, then you know that this upward rebound that we're in is intact. I'm going to say I believe it's intact. And like I said in the beginning of the show, I believe that the techs are not going to lead anymore. Healthcare is not going to lead anymore. And they're going to start to rotate and look at things that look like a bargain to them, which are financials. So that's what we're going to look at. We're going to look for the leadership to change. We're going to see if that helps the market. We're going to see if these key levels break. And we're going to see if the formation remains as it is now, which is positive, though certainly looking like it's stalling, what you see here in this last couple weeks. So again, our targets in here are really a range over the next 1 to 2 weeks, which are a potentially low of about 27.70 in here. and then a potential high moving up to about 2960 to 3000 up in this area over here, all in the context of an upward rebound in a bear market. There's no reason to think anything other than that. And if you go watch our video, Big Picture Analysis, on Thursday, you will see how I have supporting evidence to that. You think a new bull market started over here? Well, those of you that think that, I think, will be disappointed. That's it. That is our short-term view for the week for the S&P 500 and the 5 major markets. I hope you found this to be incredibly informative and that you do become an askSlim member if you are not right now. Remember, write to Matt at askSlim.com and he will give you all the information you need. Become a level 2 member or higher to be able to get the stock index report and everything else that I showed you over there. It's amazing information. We are getting emails, and you can look on Twitter even where we get comments of people saying how much it's changed their ability to make money in the markets. The key is to be able to use all this information for your trade planning and to be able to position yourself for the biggest impulses in the market. That's the key to really making a lot of money. You want to scalp back and forth for ticks here and there, you're going to drive yourself crazy and chop yourself up. Catch the bigger moves, well, that's what we teach you to do, and you learn a lot about how to do that with the stock index report. I want you to be incredibly careful. It is so crazy out there, and I'm always wishing you great trading.